Hi, everybody, and welcome to our latest edition of the McCabe Building Your Wealth Bridge podcast. After the end of Q1 2026, Will and I just wanted to, take some time and put together a video kind of covering the markets and what happened in the first quarter. I guess we are recording this on April 1st of 2026. And there's just been, a lot of different headlines going on, and we wanted to just, give everybody some thoughts on that. So with that, I'm going to share my screen. We prepared a few different slides here to illustrate some different points that we thought you all might find useful.
Hi, everyone. Thanks, Zach. So what we've got here is a chart showing investment performance for the first quarter. So January 1st, 2026 to March 31st, yesterday. And we've got 5 asset classes and kind of going in order from best performing to worst performing. The purple bar is the Russell 2000, that's the small cap index, followed by the Bloomberg US aggregate, that's the bond index. Below that, we've got emerging markets, which countries like Brazil, China, India, followed by the MSCI EFA, which is the developed international index. Think European countries, Asian countries like Japan. And then lastly, the S&P 500, which is the U.S. a good gauge of the U.S. stock market, the U.S. large cap index. So in order, you can see there they all took different paths. They're different markets, but together, we would consider this like a pretty basic asset allocation that might reflect a combination of these might reflect our client portfolios. And as you can see, we kind of first 2 months of the year started off pretty strong, and then, no surprise, things took a dip in March, after the bombing of Iran and the oil shock that happened shortly thereafter. So if we go one more slide, I think it paints a little bit of a better picture what people, is more top of mind about the first quarter of this year. There was a sell-off. So we had a shock, Operation Epic Fury on February 28th. U.S., attacked Iran with bombs, and that led to the closure of the Strait of Hormuz and created a global energy shortage. Particularly oil, like the price of oil spiked up. And what's kind of interesting, on the first slide, throughout the whole quarter, Q1, we saw the S&P 500 as the lowest performing of the 5 that we listed, which is the U.S. stock market. And then if you look at just the last month, so February 27th to March 31st, not including January and February, you can see how like the international indexes, whether it's the MSCI EFA, the developed countries, or the emerging markets, have sold off about twice as much as the U.S. market. And I think, it's easy to understand that like those countries, like non-U.S., non-North America, are more reliant on the oil that comes out of that strait, out of the Gulf. So naturally, those stock markets and economies are a little bit more sensitive to the oil shock resulting from that.
Yeah, and I think it's really interesting. Like if you look at the previous slide showing the full quarter returns, you see flat for emerging markets. The U.S. was down 5% or so. It definitely feels a lot worse than that, but I think that has to do with January and February were pretty heavily positive, especially in those international markets, and then you can see here kind of what happened in April, that there was, such a steep drawdown. But yeah, I think those are really clear, showing what happened over the quarter. We've got a couple more slides that we wanted to show you to kind of illustrate some history.
Yeah, so what we're looking at here is a bar chart of sell-offs tied to oil shocks. So going back to the first Gulf War in 1990, there's been 7, oil shocks that, have kind of had a similar path as far as the stock market. This is the S&P 500 returns after a shock. And on average, you can see 2 days after we get a shock, it's down 0.5%. followed by 2 weeks, maybe on average down 1%. 2 months later, it's positive on average a year, and then 2 years, you can see 12% and 32%, and that's the S&P 500. And let's see, 1 month after we had the oil shock, the S&P was down 5. If you take away yesterday, which there was some positive news about a possible resolution, the S&P 500 was down about 7%, 7.5% peak to trough. And today, April 1st, here we are. It seems like it's sort of recovering, and just an example that the market will potentially bottom before there's a final resolution to a conflict on a shock. So it's a forward-looking thing, very difficult to time. But yeah, that's what this chart shows.
Yeah, in all of these show, averages of those, I think, 7 different times that there's been oil shocks over the last 34 years. And if we're looking just so far, we're in this between 2 weeks and 2 months period. But the 2-week return for the S&P 500 this time around was like minus 2.5% or so. So we'll see where we're at, 2 months from the start. We'll see where we're at 1 year, 2 years. But if history is any indication, the long term is what we care the most about, and those are positive. And we wanted to show
these. Oh, sorry.
Oh, yeah, go ahead. Or you had more to add?
I was just going to say, historically, these haven't been extremely long-lived in the market. At least, we'll see how long the conflict actually goes on, but the stock market doesn't wait around too long historically.
Yeah, and even just between yesterday, the 31st, and today, we've had some positive news of all parties wanting this to end, because at the end of the day, it's not good for anybody. Oil prices being higher, lives are being lost like this is. There are people that are really being affected by this, so everybody wants to see a resolution. And this is another chart showing not just oil shocks, but other things that have happened, and kind of the long-term return implications of it. And I think everybody has kind of seen the returns of the S&P 500 or the U.S. stock market, over the last 20 or 30 years. And the chart is, for the most part, like up and to the right. And there's been so many events that have happened that have caused anxiety and concern, and that just scared people about what the future has in store. And this chart does a really good job of illustrating some of those events. From, I see 9/11 in there, I see the Iraq War, the Reagan shooting, Kennedy's assassination back in 1963, and you can see 3 months afterwards there's a lot of negative numbers on there. And then 3 months afterwards, have allow a little bit more time for the markets to do their thing, allow companies maybe to report their earnings, and then 1 year there's even less negative returns, and the really thing that matters the most is the 3-year after number. Those are all positive. Granted, they're all different levels of positive. The lowest one I see there is 1.8%. The highest one being, was at 20.7%. So, over the long term, markets do tend to recover. And I think we want to make sure that, we kind of keep that in mind, that over the long term, markets tend to work. And, that's kind of the whole reason why we build diversified portfolios. Bonds tend to sell off less than stocks, which we saw on that second slide in the first quarter. Bonds, lost money, but lost a lot less than stocks did. And bonds allow us to fund distributions from those while we, give stocks, more time to recover. And I think there's one more thing we kind of wanted to point out here, just showing, once again, things like this, drawdowns in the market is not anything new. We fully expect them to happen from time to time. I don't think anybody can predict exactly when or how they're going to, happen. But they do happen. And, over the last 72 years, we've seen 53 overall positive years, even with some big drawdowns. And on average, you can see on the left, for a 5% move on average, that happens about twice every year. And then a 10% fall in the S&P 500 we see happen about once every year and a half or so. And then 15% is about once every 3 years, 20%, once every 6 years or so. So, things like this do happen from time to time. It doesn't make it any easier. It's still tough for all of us to kind of get through, but, we know we've experienced this before, and, hopefully you're going to be investing for a long time in the future, and we are going to, see this, many times, well, hopefully not that many, but I'm sure it'll happen again in the future. But this is things that we plan for, especially as we build portfolios.
Yeah, and I think with the last chart and this one, similar messaging, but the challenge is each event that happens in real time, or what you think is going to happen in the future as a result of this particular conflict, is that each one seems more dire and current. And if you think about the last 6 years, we've had 3 of this kind of shock, with like an oil or supply constrained shock. And people, naturally want to extrapolate what this is going to do to the future, and let yesterday and today be an example of how quickly the market can rebound, recover, even when it's not necessarily resolved, because it's a forward-looking indicator of events. And the other challenge would be, I think a lot of people who've been long-term investors are potentially, in their own portfolio at an all-time high point in January and February. After 3 strong years in the market, you've been invested for a long time, compounding has worked for you, and now you see, flat to, small percentage down moves, and it can be big dollar moves. So we emphasize these points just to really, hammer home like the importance of not letting, current events, news headlines, or short-term pullbacks disrupt your longer-term financial plans.
Yeah, and Bill, I think you kind of said something there that really caught my attention. Of, I was talking in terms of like percentages of 5% or 10%, and it means a lot more when it's dollars. And like a 10% loss on $1 million account is $100,000, which is, yeah, it's a tough pill to swallow. It's tough to get through, but we know, we gotta sit tight and get through it. And after, a few years of really strong returns, portfolios have grown considerably, and, that 10% loss is on a, larger dollar amount. So it's definitely tougher to get through. And I was looking back historically, this is the first negative quarter that we've had, at least for the U.S. stock market, since Q1 of 2025, when we had, we'll call it a tariff war around Liberation Day. So we've seen things like this before, and Will, I feel like we've been kind of doom and gloom a little bit here in this. Maybe we'll end this with some positive things, and things that we kind of expect to continue on for the rest of the year. And I think this is a really interesting chart showing, overall the U.S. market kind of contributors, where everybody's has heard of the Magnificent Seven names, those big technology names. You can see that divergence in returns from 2023, the Magnificent Seven on that left-hand bar chart, returned 112%, where the rest of the S&P 500, the other 493 companies there, averaged about 24%. And you could see 2024 was the same thing, just to a lesser extent, where Mag 7 outperformed. In 2025, similar to a lesser extent. But 2026, we saw what we call like a broadening of the market, where maybe the S&P 500 was lagging a little bit, but the rest of the names in the index were performing well, which is something we've kind of been expecting to happen for a number of years here. And it happened in January and February of this year. Things in March obviously got a little sidetracked with what was going on in the Middle East, but I think that's a trend that we would expect to continue. And also in that first quarter in January and February, we saw international markets do a little bit better than the U.S. And I think there's a number of different reasons why. I know we've talked about a little bit before. Europe is now spending a little bit more on their defense than maybe they once did. company or countries like Germany are contributing more towards infrastructure spending, which is increasing their overall GDP, which is great for the international markets. In the emerging markets, we've seen more companies that are having more like most call it like shareholder advocacy, where I think it was Japan, their stock market sent letters to every company saying, all right, what are your plans over the next 3 to 5 years to increase shareholder value. So we're seeing different things happen there, more spending in Japan as well from fiscal spending from the government. So there's a lot of different things that are contributing to what we would expect positive returns for markets over the long term. There's a lot of good things happening out there as well.
Yeah, and here in the U.S., there's some really big themes that are playing out. This shock aside, deregulation is something that we've talked about in the past, and what we're seeing, or expecting to be here, whether it's SpaceX launching their IPO. I think they just filed, they did a more private filing, but you can expect that company is going to be a big part of the U.S. stock index here shortly. And then later this year, companies like OpenAI and Anthropic, some of the big AI names that have been private this whole time, are probably going to be added to the index this year. And maybe they've strategically waited for a good opportunity, the right market, you name it, technology, grid, a lot of factors go into that. Another positive for the market this year that we're seeing is the tax law that was changed last year, potentially adding about $200 billion in stimulus for taxpayers. So higher gas prices maybe offset with lower tax bills could be a huge thing for consumers. And then the other thing would be monetary policy. So, the Fed was on track to cut rates maybe twice this year. I think this oil shock, had changed inflation expectations in the near term, maybe pricing in now one rate cut this year and more the following year, but that's still unknown. The Fed has a dual mandate, as we know, maybe you've heard that on the news before, where inflation and price stability is one part of it, but it's an equal importance with the labor market. And we've seen some weakening, which is normal because it was coming from a really strong place after the COVID recovery. So dual mandate, and there's going to be a new Fed chair this year who, maybe is a little bit more forward looking and not as data dependent, can influence the other members. So things that can lift markets and promote more growth here in the United States as well as overseas.
Yeah, so I think that there's, obviously a lot of concern going on right now with everything that happened in March and the war in the Middle East. But, as Will just said, and some of the items I said, I think these long-term trends are still intact. And, companies are out there spending billions, tens of billions of dollars on AI.
Hundreds of billions.
Hundreds of billions. I wasn't sure if trillions was the right word. I don't think so. So hundreds of billions of dollars. And we would expect, all the companies to benefit from that at some point down the line. And at the end of the day, we are investing at companies whose sole purpose is to increase their earnings and increase their stock price for their shareholders. So I think there's a lot of exciting things going on around that. But yeah, I think that kind of covers everything that we had planned to talk about. If you have any questions about what we spoke about, please feel free to reach out to your advisor. We're here to answer any questions. All right, perfect. Thank you all. Take care.